My name is Adam Posick, and this session is going to be about multiple employer plans, or what I like to call aggregated plan arrangements, as you'll see as we go through the slides. Before we get into the details, let's take a look at a brief history of multiple employer plans and provide a little bit of context. For starters, a multiple employer plan is going to be a retirement plan, that covers multiple unrelated employers. So we discussed in a previous session companies that are related by either a controlled group relationship or an affiliated service group relationship. In those circumstances, because of the commonality, because of the relationship of those companies, they can sponsor what's called a single employer plan. So even though there are multiple companies, they're considered a single company for retirement plan purposes. So the plan covers multiple related employers. It is a single employer plan. A multiple employer plan is where there's not enough overlapping ownership, and so you have multiple unrelated companies that are still in the same retirement plan. Thus, we have a multiple employer plan. As we can see on this slide, there are several situations where there might be a multiple employer plan in place. So for starters, you have the sort of an association arrangement. So there was a Department of Labor Advisory Opinion back in 1981 discussing a multiple employer plan for the YWCA, the National Association, and each of its chapters. So that was a circumstance where a multiple employer plan made sense. You also have a situation where you've got a group of companies that have common ownership, but the level of common ownership isn't quite high enough for it to be a controlled group. As you might recall from a previous session, that threshold is generally going to be 80%. So you might have the same people who have ownership in two or more companies, but that common ownership is below 80%. So there's still a reason for them to kind of work together to provide certain benefits and so forth, even though they're not considered a single company under those related employer rules. So that's going to be a very common situation where we might see a multiple employer plan. Another situation is where you have commonality of business interest. Probably the easiest example to illustrate this would be a franchise situation, such as Dunkin' Donuts, which was the subject of another Department of Labor Advisory Opinion back in 2005. So you have the kind of the national Dunkin' Donuts, and then you have franchisees that are a part of that. And even though the franchisees operate as independent entities, they're still tied to the mothership with respect to obtaining certain goods and supplies and following certain set standards in order to maintain branding and the reputation and the name of the company overall. And then more recently, we've had the open or unaffiliated multiple employer plan that has become more prominent. And we saw these back in the early 2000s and even before that in the professional employer organization or PEO context. But more and more there has been interest among other unaffiliated groups that it might make sense to pool resources to leverage increased buying power and have a single plan covering multiple unrelated entities. So those are four general types of multiple employer plans that you might see out in the industry. So over the course of the last few years, there has been increasing interest among service providers that it would make sense, increase buying power and so forth, to pool a bunch of smaller companies that might not want to spend the money, that might not have the resources to have their own standalone 401k plan. So let's gather those together and create a single defined contribution multiple employer plan that provides large company benefits, large company buying power to a pool of smaller unrelated companies. And that's what has come to be known as the open multiple employer plan, or the open MEP. Most of the rest of the session is going to talk about open MEPs and the way that the law has evolved in that area. There is still very much a need for multiple employer plans when you're talking about those collections of entities that don't have the common ownership, that common relationship to be a controlled group or an affiliated service group. So again, going back to the comments on the previous slide, you've got the same group of people that maybe only have overlapping ownership of 50% rather than the 80% needed to be a controlled group. There would still be a need or a benefit to those companies combining, sponsoring a single plan. Again, because they're below the threshold to be officially related, it would be considered a multiple employer plan. So again, going forward, most of the rest of this session is going to talk about the evolution of the open multiple employer plan and pronouncements from the Department of Labor and what that has done to the industry. So prior to 2012, what you see on the screen is the guidance that we had. So we had the Internal Revenue Code Section 413C, ERISA Section 210. That was the primary statutory guidance discussing multiple employer plans. We also had an IRS revenue procedure from 2002 discussing how professional employer organizations, or PEOs, would go about providing retirement plans to all of the recipient employers. And basically what the IRS said in that RevProc is that to the extent a PEO is otherwise interested or able to provide retirement benefits to the recipient organizations, the only way to do that would be through a PE or through a MEP type arrangement. So it didn't necessarily give carte blanche blessing to every PEO to sponsor a MEP. All that revenue procedure said was that if a PEO wanted to provide retirement benefits, the only avenue to do that would be through a multiple employer plan type arrangement. We also had more than 40 Department of Labor advisory opinions going back for decades. And there's been a little bit of disagreement, or there was some disagreement, as to whether or not those were applicable to the 401k type MEP. And that's because most of those advisory opinions dealt with multiple employer welfare arrangements. So again, you have multiple unrelated employers getting together, but in those contexts, at least most of them, this discussion was around providing health and welfare benefits, not around providing retirement benefits. And there was a lot of disagreement in the retirement industry as to whether those same opinions and that same reasoning would apply in the context of a multiple employer retirement plan as opposed to a health and welfare plan. And then we also have the court case noted on screen back from 1992. So that was the guidance that we had. There wasn't really a whole lot more than that, and a lot of it was sort of, seemed to be a little bit vague and required some connecting of the dots and filling in some blanks. So the big question that bubbled up from the varying interpretations and some of the uncertainty is whether or not a multiple employer plan is a single plan under ERISA or a series of separate plans, sort of a collection of separate standalone plans sponsored by each separate employer. And the reason that became important, especially in the context of these open or unaffiliated MEPs, where you have companies that had really no connection beyond just pooling resources to provide benefits, is that if it's a single plan under the law, under ERISA, then you only have to file one Form 5500 for the entire collection, as opposed to separate 5500s for each separate standalone employer. More importantly, that means that for plans that have more than 100 participants, only one independent qualified public accountant audit each year. And those audits certainly run into a 5-figure price tag. So if you have a collection of, say, 10 companies that have more than 100 employees, rather than each one incurring a separate 5-figure price tag for its own standalone audit, put them all together into one big multiple employer plan, and now you're only paying for one audit rather than multiple for each company. So there's potentially a pretty big cost savings there. The Form 8955 SSA, if we're talking about a single plan, we only need one of those versus multiples. With a fidelity bond, so the bond that's required under ERISA to protect the plan against fraudulent misappropriation of assets. If we have one plan, we only need one bond. If it's considered a collection of separate standalone plans, then we would need a separate bond for each one of those separate plans. So some pretty important implications stem from answering this question of whether one of these open, unaffiliated MEPs is a single plan or a collection of separate plans. And that brings us to the middle of 2012 and a very pivotal advisory opinion from the Department of Labor, and that's DOL Advisory Opinion 2012-04A. And in this circumstance, the sponsor of an open MEP went to the Department of Labor, described the arrangement that it had, and asked the question very directly, is this a single plan or is it a collection of separate plans? And this advisory opinion came out with some pretty important conclusions that removed quite a bit of the ambiguity that had been circulating prior to this point. Skipping to the middle of the screen first, one of the important things that the DOL noted is that reviewing the facts and circumstances to determine whether or not what we have is a true MEP or a collection of separate plans, all of the previous advisory opinions, even those dealing with MEWAs or multiple employer welfare arrangements, those still apply. So the logic, the reasoning doesn't change just because we're talking about retirement plans versus health and welfare plans. So now all of a sudden, decades worth of history and over 40 DOL advisory opinions very clearly should be applied to the analysis of a multiple employer defined contribution retirement plan as well. So that gave us a lot of clarity right there. Moving on, the Department of Labor said that no two unrelated companies can sponsor a single plan unless those companies have some sort of commonality and control. So you could have members of a group with an association type relationship. So again, going back to the YWCA example we talked about in a previous slide, and members of that association have to control the plan directly or indirectly. So it can't be an arm's length where we all get together and say, yes, we want to have a plan, and then we all sail off into the sunset and leave management or control of the plan to somebody else. All of the employers that are a part of that plan have to participate in the control of it, either directly making decisions or indirectly, for example, voting on appointing members of the committee that's going to manage the plan. So that would be an example of an indirect level of control. Another important point that the DOL made in this advisory opinion is that we have to keep in mind the ERISA definition of an employer. Under ERISA, a company has to have employees in order for it to be an employer. And an owner of a company is not considered to be an employee. So an owner-only company, for example, a sole proprietorship that doesn't have any employees, is not going to be considered an employer under ERISA because, again, the employer has to have employees. Therefore, if that sole proprietorship joins on to an otherwise applicable multiple employer plan, then that's going to change the nature right there, because for the multiple employer plan to be one plan under ERISA, it can only cover employers. Since that sole proprietor is not an employer under ERISA, the fact that it joins the plan blows the plan status as being a valid multiple employer plan. So a couple of very important points, certainly because when you looked at some of the open multiple employer plans that were in existence, they were being marketed to small entities like sole proprietors that might not have employees to help make things easier for them to have a plan without incurring all of the administrative hassle and expense. So some pretty important and revealing and clarifying comments from the Department of Labor in this particular advisory opinion. Continuing on, basically what came out of this advisory opinion is that in order for a collection of companies, unrelated companies, being part of a plan for it to be a true MEP, we have to have the two C's, and the C's stand for commonality and control. So basically the participating employers have to have a common employment bond, so going back to the YWCA. Again, there's a bond there, they have a common mission, they have a common purpose. Looking at a situation where you have companies that have common control or common ownership but less than the 80% required for a controlled group, you still have this commonality of business purpose. And that's a theme that comes up not only in the 2012 advisory opinion but in previous ones as well. And a chamber of commerce might be a situation where it seems like there's commonality of business purpose, promoting business in a certain geographic region. But there was a Department of Labor advisory opinion from a few years back that said that that's too broad, that doesn't create enough of a tie, enough of a commonality of business purpose to satisfy this commonality requirement in order to be a true multiple employer plan. The other thing is control, and we talked about that a slide or two ago, how the participating employers have to control either directly or indirectly the management of the plan. So they're either involved in making decisions, or again, the example of indirect ownership, they are involved in appointing the members of the retirement plan committee who would then make the decisions. So without commonality and control, basically what the Department of Labor said is you cannot have a true multiple employer plan that would be a single plan under ERISA. Rather, what you would have is this collection of separate standalone plans that are just pooled for the purpose of selecting service providers, but still individual plans. So it creates some interesting disconnects. So, going back to the question, do we have one plan or do we have multiple plans? Well, the answer is yes. You have multiple plans under ERISA because, again, no commonality, no control in these open MEP situations. The Department of Labor said that's a collection of separate standalone plans that each have to file their own 5500s, have their own bonds, all of that sort of thing. But if you look at the tax code, it's still going to be treated as one plan for code qualification. So compliance with the testing requirements, all of the operational requirements. Basically what the IRS says is that the entire group, the entire plan, has to satisfy all of those qualification requirements, or else the entire plan is considered disqualified and subject to back taxes and penalties. So it certainly creates some challenges. Another one of those has to do with prohibited transactions. Code section 414L kind of points to some different areas. 413C says that all assets of the plan have to be used for all benefits under the plan, but at the same time, commingling assets can only be accomplished in sort of a collective trust, that sort of a situation. So, on one hand, all of the assets have to be available to provide benefits for the entire plan, but under ERISA, you have separate plans, and having the assets of one plan being made available to provide benefits to another plan is a prohibited transaction. So certainly leads to a lot of head scratchers and a lot of open questions in terms of ongoing operation that are yet to be answered. So that sort of begged the question, what do we call these things? Prior to 2012, they were referred to as open MEPs. But according to that Department of Labor Advisory Opinion, they're not really MEPs at all, so is it appropriate to even call them that? A couple of things just to add some levity here to some potential names. But that kind of gets us to the bottom of the screen here, and I said at the beginning what I like to refer to as aggregated plan arrangements. That's what we'll go with for the remainder of the session here, because it seems like that more clearly describes what we're dealing with. We can't really continue to call them open MEPs, even though for marketing purposes some people still call them that, because they're not MEPs at all. Really what we have is a collection or an aggregation of separate standalone plans that are just pooled in order to maximize their buying power. So we'll go with aggregated plan arrangement, or APA, for the remainder of the session. So even though an APA is a collection of separate plans and doesn't qualify for filing the single 5500, the single audit, and all of those sorts of things, there are still some advantages to this sort of an arrangement. One is professional compliance management. Typically what we saw before the advisory opinion, and even since then, is that the entities that are sponsoring these APAs have some degree of professional compliance experience. It's not just some random Joe Blow going out and saying, hey, I want to put together a 401k plan for a bunch of my buddies that have companies. It's usually service providers that are already in the industry and have some sense of how the plans are supposed to operate. So it still does provide a little bit of assistance to the small employer that isn't as intimately acquainted with all of the detailed laws and regulations that drive a compliant retirement plan. So there is that advantage. We've talked about group buying power due to a larger pool of assets, maybe qualifying for a better priced class of institutional shares or things of that nature. We talked about less burdensome for the employer, so there are fewer administrative obligations. So those small businesses can spend time running their businesses rather than trying to understand, how to provide a certain disclosure to employees or make different selections and so on and so forth. Also, you have a lot of the investment decisions that can be intimidating to some small employers being made at the sponsor level. So the APA sponsor is going to work with an investment advisor, and they're generally going to come up with a menu of investment options to offer to the entire collection of plans, rather than each separate standalone plan having to choose its own investment menu. So that can be a blessing and a curse. I mean, it certainly reduces some of the fiduciary responsibility that falls onto the plan sponsor, in that you've got the APA sponsor and the investment advisor making those choices. But at the end of the day, it is still a fiduciary decision by the business owner to join or sign on to a certain aggregated plan arrangement, so they still remain on the hook to some degree for ensuring that all of the fiduciary decisions are prudently made and monitored. There are a couple of disadvantages. One pretty critical one is the one bad apple rule, and this is what I was referring to on a previous slide. In that if one member of this aggregated plan arrangement makes a mistake, either accidentally or intentionally, in terms of running their portion of the plan in a non-compliant manner, it jeopardizes the tax qualification of the entire plan. So If you've got a big APA that covers businesses all over the country, you could have a business in the Pacific Northwest that makes a mistake on its portion of the plan, and that jeopardizes the tax benefits that a company in South Florida, complete opposite end of the country, might be receiving. Again, because they're both part of the same aggregated plan arrangement, and because the IRS looks at tax qualification on the entire thing, one bad apple can certainly spoil the entire bunch. As a result, what we've seen is that many of these APAs have a contractual provision that says if an employer makes a mistake and isn't willing to step up to fix it, that the APA sponsor can kick that employer out of the plan. And that certainly helps prevent ongoing failures, but there's still a situation where you've got a failure that needs to be cured, and so there's this open question of whose responsibility is it to fix it after you've kicked out the bad actor. So again, it's not necessarily clear how that works, and how the costs of curing that failure are going to be borne among the remaining adopting employers. Another potential disadvantage is that bigger isn't always better. Working as a small company with a small local or regional provider, that company might get a lot of hands-on or personal attention from their local provider. Being part of a big national pool, being with a big national provider, the sponsor at the top, the aggregated plan arrangement sponsor, might get a lot of attention from the service provider, but the individual companies probably aren't getting as much attention. And that's going to be somewhat subjective, depending on how much a given company wants that attention. But for a small company that's used to getting that hands-on, one-on-one attention, moving to an arrangement like this is more likely to make them a small fish in a very, very big pond, which might not be looked on as a positive. Another instance of bigger not always being better is that a small plan that has fewer than 100 employees isn't normally required to have that annual audit by a CPA. So yeah, it's great that pulling everybody together might allow for a single audit or at least a reduced cost audit. Well, if you're a small company, you don't need an audit anyway. So why do you want to share in the cost of an audit when you wouldn't normally have to do so? So again, there's certainly some advantages in terms of the professional arrangement, the professional management, the larger pool and the group buying power. But again, when you have this large group, one company can end up being responsible for the sins of another and could end up having to share in the cost of an audit that they wouldn't normally have to pay for. A couple of other potential disadvantages is that when a company signs on to an aggregated plan arrangement, they're usually just sort of buckling up and they're along for the ride. They don't have a whole lot of control with respect to some decisions that they would normally have a say in. The selection of other service providers. So again, going back to the audit as an example. The sponsor of the APA at the top is typically going to be the body or the individual that's going to choose the accounting firm that's going to do the audit of the plan. The individual adopting employers typically aren't going to be involved in those sorts of decisions. Might be a good thing, might be a bad thing, depending on the circumstances. Again, selection of the investment options. It helps to have that done up at the top with the assistance of an investment manager. Again, access to maybe better priced institutional class funds and things of that nature. But if a particular smaller employer that's part of this arrangement maybe has an interest in adding some socially responsible funds to the mix, well, they might not have a say in that matter because, again, they're not involved in the selection of the funds. That's happening kind of at the top of the food chain. Amendments of the plan, selection of certain plan provisions, just sort of other examples of situations where the employer might have a loss of control that they would normally have if they had their own separate standalone plan kind of working on their own. Another potential disadvantage is that if a company wants to get out of the APA, they can do that, but they're going to need the APA sponsor in order to implement. So it's no longer just a unilateral decision on the part of the employer. They need to have other people that need to approve and sign off on the decision in order to make it happen. And this can certainly cause some angst with regard to timing. If a company is maybe going out of business and they want to be able, or the owner's going to retire and they want to shut it down quickly, they might not be able to act as fast. If the employees want to be able to get their money out when the plan terminates. Again, that may or may not be possible within the time frame that everybody wants it to happen because you have more people involved, and the more cooks you have in the kitchen, the longer it's going to take to get those decisions implemented. So let's talk a little bit about some of the day-to-day issues that come up when dealing with an aggregated plan arrangement. Okay, non-discrimination testing. And this is not so much of a change specific to aggregated plan arrangements. Whether you have a MEP or an APA, what you see on the screen right now is true, and that's that each employer has to be tested separately. If you have companies that are related, that are part of the same control group or the same affiliated service group, like we talked about in a previous session, then they're going to be combined for testing purposes. But anytime you have unrelated employers, regardless of the plan structure, MEP or APA, each one of those employer groups is going to have to be tested for non-discrimination separately. So the coverage test, the ADP test in a 401k plan, certain definitions of compensation that are subject to testing, that's going to be done separately. The top-heavy determination to make sure or to determine what percentage of plan accounts are for the benefit of owners and officers. Again, each one of these things is going to be done separately for each separate adopting employer. Plan documents. Those could be different depending on whether you have an APA or whether you have a true MEP. When you're dealing with an APA, sometimes this is done through a single master document that has all of the legalese in it, and then each employer that wants to be part of it, they'll sign a joinder or a participation agreement. And that's fine to do that in an APA. The Department of Labor's advisory opinion didn't say that you can no longer have this sort of a plan document situation. One of the challenges, though, is that as a result of the advisory opinion, this master document arrangement, typically you're going to want to see a disgorgement feature. Again, going back to that one bad apple rule, there's going to be a provision in there that provides for kicking a bad actor out of the plan. You might have provisions that allocate responsibilities to the different people who are charged with managing the plan. Some of those types of features might not fall neatly within an IRS pre-approved document, which would require the document to be individually drafted by an attorney and submitted to the IRS for separate approval. Those things cost money. So again, there's more flexibility in how you draft the documents to accomplish certain goals, but that flexibility often comes at a higher expense, which is going to be passed on to each of the adopting employers and potentially the participants in the plan. So kind of two edges to the same sword. Another alternative, with the APA, is to have separate plan documents for each adopting employer. If they're all tested for non-discrimination separately, if the Department of Labor already looks at them as separate plans that have to file their own 5500s, why not have separate plan documents and then maybe some sort of a joinder agreement that acknowledges sort of the pooling of assets and group buying power? In that sort of an arrangement, you're much more likely to have pre-approved plan documents, so prototypes or volume submitter documents that are going to be able to be drafted and maintained at a much lower price point. So just a couple of different things to consider with respect to the plan document. Accounting service and eligibility is another interesting disconnect. When you have a true multiple employer plan, both ERISA and the code require that all adopting employers recognize service with all other adopting employers in that same MEP for purposes of eligibility, vesting, and those sorts of things. However, an APA, after that 2012 DOL Advisory Opinion, isn't a single plan. It's a collection of separate plans under ERISA. So ERISA Section 210 isn't going to apply because we don't really have a MEP. But on the flip side, Code Section 413C does apply because we essentially have a single plan under the code. So 210 says you automatically, or both of these say that you automatically recognize service with all adopting employers. But again, ERISA says it's not a MEP. The Internal Revenue Code says it is still a single plan, so what do we do? Well, I think it depends on the desired outcome. One way to be safe is just if the goal is to recognize service with all the adopting employers, is to specifically say that in the plan document. And that way you're removing any sort of ambiguity. If the goal is to ensure that service is not credited across adopting employers, then going with separate plan documents so that we're really treating these as separate standalone plans for all purposes is going to be the more expedient way to accomplish that. So again, we have what appear to be some competing statutory provisions, and those can be overcome if we first identify what the desired outcome is, and then just making sure that the plan documents reflect what it is that we're intending to do, then we can address some of these open questions. Okay, government filings, we've talked about the Form 5500 and the Independent Qualified Public Accountant Audit, as well as the 8955 SSA. These are going to have to be filed separately, whether you're treating them as separate standalone plans, whether you're going with the APA arrangement, it doesn't really matter. One of the questions with regard to the 5500 is who signs. If you look at the blanks at the bottom of that form, it can be either the plan sponsor or the plan administrator. So if you have an APA sponsor that is acting as the formal legal plan administrator, then it may be possible for that APA sponsor to sign all of the 5500s for each of the separate plans. Alternatively, it might make sense for the individual companies that are adopters to sign as the individual plan sponsors. We've talked about the audit. Now, one thing that's interesting is that Department of Labor representatives have informally, in speeches and the like, indicated that they're probably not going to go back to pre-2012 years and say, hey, you know, individual adopters of this APA, you should have been filing separate 5500s all along. You need to kind of cough those up and provide them for us. Now, again, nothing formal that you can take to the bank, but again, you did have DOL officials that said we're probably not going to look backwards. What they didn't say, though, is from 2012 forward that they wouldn't take enforcement action against APAs that continue to treat themselves as MEPs and file only a single 5500 rather than separate 5500s for each adopting employer. There are still plenty of arrangements out there that, in looking at the 2012 advisory opinion, certainly look like they're APAs and should be filing separately. However, they're not treating themselves that way. So it creates an interesting situation for companies that are part of those arrangements that thought they were a MEP, that now more than likely they're probably not a MEP and they're probably an APA. And what do? They're caught in the middle. Their APA provider is telling them they're a MEP and they don't have to file separate 5500s, but an independent analysis of the 2012 advisory opinion might lead to a different conclusion, so what do? In that circumstance, it's really just kind of a risk tolerance analysis that employer has to do to determine, you know, how much they want to side with the APA provider, or whether they might want to take some corrective action on their own and file separate 5500s for themselves. A similar situation with the Form 8955 SSA. A couple of other important questions that come up because, again, legally we're talking about separate plans that are just pooled for buying power in this aggregated plan arrangement. That goes to the delegation of duties. So who is the plan administrator? That party is usually named in the plan document, and in many, many plans it names the employer, so the company that's sponsoring the plan. So in an APA, is the individual company the plan administrator, or is the APA sponsor the plan administrator? Very important to make sure that everybody knows who's acting in that capacity, because again, the plan administrator is the one that signs the 5500, they approve loans and distributions, they've got a lot of authority with respect to the plan, so it's important to know who that party is. It's also important to know who the responsible plan fiduciary is, and that's a term that comes up under the fee disclosure regulations under 408B2, which is fee disclosure by service providers to the employer, and 404A5, which is fee disclosure from the employer to the participants in the plan. So it's very important to understand who has the responsibility to ensure those disclosures are timely provided to the appropriate parties. You know, a couple of miscellaneous concepts. We talked about the fidelity bond earlier in the session, and that's the bond that covers the plan against fraudulent misappropriation of plan assets. So it doesn't cover any individuals. It's not fiduciary liability insurance. It covers the plan. So because the DOL said that an APA is a collection of separate standalone plans, that means that you can't have one bond that covers the APA in aggregate. Essentially, each separate standalone plan has got to have its own bond. Now, there was a DOL Field Assistance Bulletin from 2008 that did say you can't have a single bond that covers multiple plans. So the APA sponsor could obtain a bond for the entire APA as long as it names each of the separate standalone plans in it, and also as long as the bond amount is determined separately for each standalone plan, and those separate amounts are added together to arrive at the bond amount. So as long as it's handled that way, there can be one bond that covers multiple plans, but under an APA, you can't have one bond that covers everything as if it was one plan. So an important distinction there. Another one that's a little bit more esoteric, but certainly as important, and that's the audit risk. Both the IRS and the Department of Labor use the Form 5500 to some degree in selecting which plans they're going to audit. That could be audits for cause. They see something on the 5500 that looks problematic and they want to go check it out. Or maybe they're just compiling lists and they say, hey, we want to audit all companies that satisfy certain criteria just to make sure there's not sort of some systemic industry-specific issue going on that we should know about. Either way, both agencies use the 5500 in selecting which plans they're going to audit. So if you have a true MEP, and let's just say it's made up of 1,000 companies, there's one 5500 being filed, so the likelihood of any one of those individual companies being selected for audit seems a little bit lower because, again, they're all part of one big umbrella. When you have an APA and each of these 1,000 companies is filing its own 5500, now you've got 1,000 opportunities for a plan to be selected for audit. And if any one of these 1,000 is selected, and either the IRS or the Department of Labor comes in and starts reviewing documentation, and they see, hey, even though this company filed its own separate 5500, they're purporting to be part of this larger aggregated plan arrangement, perhaps we should take a look at the entire thing. And does that then open up the other 999 adopting employers for an increased audit risk anytime any one of the employers in the mix gets selected? Very difficult to quantify. Theoretically, it seems like it's going to raise the likelihood of getting selected for a random audit, but it's still kind of too early to tell what the practical impact of that has been. Another question that oftentimes comes up too late in the game, but should really come up at the beginning when a company is considering whether it wants to get into one of these APAs, is what does it take to get out? There are some arrangements that make it very, very difficult. They make it expensive, they make it time-consuming for a company to get out of the arrangement once it's gotten in. So it's very important for a company to understand going into the arrangement, when I want to get out, when I need to get out, can I do so cost-effectively and easily without making it burdensome to do so? When a company wants to get out, sometimes it's because maybe the company doesn't want to have a plan anymore, or because the owner is retiring or something along those lines. But let's just say you've got a company that wants to continue offering a 401k plan, they just don't want to be associated with the APA anymore. Well, there are a couple of steps that are involved in that sort of an exit. So certainly there's the plan document, so restating the plan document so that it very, very clearly indicates that there's no more affiliation with the APA. But then you typically have some sort of a spin-off agreement that formally disgorges the assets from this kind of pooled, aggregated arrangement and moves them into the trust of this kind of newly created, very clear standalone plan. So that a couple of different documents that are required. It's not just as simple as saying, okay, we want out, and then kind of going on your merry way. These are pretty easy steps to take, but it is important that they be followed nevertheless. Another question is whether the employees can get their money out. Well, transitioning out of a MEP or out of an aggregated plan arrangement does not create a distributable event on the part of the employees. Unless the company is shutting down, either it's going out of business or the owner's retiring or something like that, the employees still have a job. Just because they're no longer affiliated with this aggregated plan or this MEP like they were before doesn't mean that they were all fired. And typically you need to have a separation of service for employees to be able to take a distribution. So important to keep in mind that spinning out of one of these arrangements does not create a distributable event. The employees are still employed. So really one of the only ways, if the company does not want to maintain a plan, if they want to give employees access to their money, is to spin out of the aggregated arrangement and then immediately terminate the plan, and the plan termination does then trigger a distribution right. One challenge, if you're on the APA sponsor side, so not one of the individual companies, but you are creating and managing one of these APAs, is what happens if one of the individual employers abandons the plan. They just decide they don't want to fool with it anymore. After all, you're the APA sponsor. It's your problem, and they just walk away from it. So again, very important thing to understand before a company signs on to an APA is where the responsibility lies and who will wrap up a plan in a situation where an employer walks away. Always easier to address those things when everybody is feeling good about it on the front side rather than at the back side when there might be some bad blood or some tension that would cloud the ability to come to a reasonable conclusion on those. And we talked earlier about some of the advantages to the APA, kind of the professional management, the economies of scale, and so forth. But there are definitely some alternatives to the APA arrangement. As more and more companies have gotten into the retirement business, certainly the cost of providing those services has come way down. It's not as expensive as it was 10 or 15 years ago for a small business to go to a record keeper, to go to an investment provider, to go to a TPA and get professional management at very competitive price points. So there's some question as to whether this pooling of resources and increased buying power really provides much of a benefit as compared to what it might have years ago. So because the decision to join an APA is a fiduciary decision, and because a fiduciary, the owner of a company, is essentially choosing all of these different service providers when it chooses to join the APA, it's very important to go through and look at the underlying services, determine whether the deal that's being offered is really that good of a deal, whether there aren't cost-competitive options outside of the APA in terms of the services provided, in terms of access to investment options, and things of that nature. So an APA can certainly provide some advantages, but there are alternatives that can provide those same advantages at a very cost-competitive price point. The concepts that we've talked about this session are pretty involved, and we've only touched on them at a surface level. We could easily spend 4 or 8 hours digging into all of them in detail, looking at the history of MEPs, looking at a lot of those advisory opinions as to the concepts behind them and how the law is developed. For anyone who wants to dig into it on a more detailed basis, we have some additional resources. We've got a couple of articles that were both published in the Journal of Pension Benefits in October of 2012, which is just after that DOL Advisory Opinion was published. It was published Memorial Day weekend in 2012, so at the end of May. So some very knowledgeable attorneys that have dissected the history and kind of put pen to paper to describe what they think in the aftermath. So definitely worth checking those out. And then the Department of Labor advisory opinions that I referred to. This is not a complete list, but these are some of the key ones that talk about some of the issues that come up both in the context of MEWAs as well as multiple employer retirement plans. Very enlightening. Again, for those of you that want to get into the detail here, I would strongly recommend reading through some of these. And that concludes our session on multiple employer plans and aggregated plan arrangements. If you have any questions or comments, please post those out to the discussion boards.